Good day, everyone, and thank you for joining us on this call on the 9 months first HoldCo 9 months results conference call. Thank you for being on the call and for your continued interest in first HoldCo. So we'll start with an overview by the Group Managing Director, Wale Oyedeji. And just before then, if you have any questions, please use the raise hand function, and you'll be called upon to speak by unmuting your lines. And the questions will be taken in batches. And if you have any further questions, follow-up questions, that is, please feel free to always indicate to take those follow-up questions. And then once the questions, you finish the questions, please mute. And questions will also be taken intermittently from the Q&A section of the platform. And so without much ado, and I welcome Wale for his opening remarks. Please go ahead.
Good day, ladies and gentlemen. I welcome you to today's call, where we'll be discussing our 9 months 2025 results. Joining me on this call are Segun Alebiosu, the CEO of First Bank. Ini Ebong, the Deputy Managing Director, will be online. Tolu Oluwole, Head Investor Relations, who has already introduced himself. Also on the call are Wasiu Shafe and Yemi Adesanya, the Financial Controllers for First HoldCo and First Bank, respectively. I will begin by providing a brief overview of the key financial and operational highlights for this period, and then we will proceed directly to Q&A. On slide 5, I'll begin by sharing some insights into the key financial highlight for the period, which demonstrates the inherent strength of our group. Gross earnings increased by 17.1% year-on-year to 2.6 trillion naira, driven by growth in our core business, with net interest income up by 71.7% on the back of loan growth and optimization of earning assets, and an improvement in our cost of funds to 4.9% from 5.6% in the prior year. The decline in profit before tax is directly attributable to the normalization of fair value gains and the measures implemented to strengthen the balance sheet for the long term. Our strategic risk management initiatives are already yielding positive results, as evidenced by an improvement in the NPL to 8.5%. The strength of our business model is reflected in the improvement in gross fees, commission income, which is up 26.9% year-on-year, underpinned by robust growth in income from letters of credit, e-banking, and funds transfer and intermediation. We're pleased to announce that First Bank, our flagship subsidiary, successfully redeemed its $350 million Eurobond upon maturity on October 27, 2025. This redemption demonstrates the group's strong foreign currency liquidity and sound liability management, further establishing our reputation as a preferred issuer within the international investment community. During the period, leading credit agencies such as S&P, GCR reaffirmed their ratings for HoldCo and the bank, which further validates the group's robust and enduring credit quality and stability. Additionally, we launched our 7th Digital Experience Center, further strengthening First Bank's position as a leader in innovation and customer-focused banking. Each center is designed to enhance accessibility, efficiency, and personalized service, providing an improved and seamless banking experience while upholding our commitment to pursuing and prioritizing our customers. We're proud to have achieved the landmark integration of the Pan-African Payment and Settlement System, PAPS, into a digital platform, expanding our cross-border payment capabilities, strengthening our capacity in digital services, and facilitating intra-African trade under the AfTA. Our network of agents continues to grow. We now have over 308,000 agents, creating more than 700,000 jobs. These agents process over 170 million transactions during the period. To conclude on this slide, I want to reiterate that our financial targets and strategic approach for 2029 remains unchanged. The fundamentals of our business are solid, and we plan to continue to grow and generate value for our stakeholders. Moving on to slide 6 for some key developments, I want to update you on our forborne facilities and the recapitalization process. I know you're interested in this. As mentioned previously, the NPL improved to 8.5% following recoveries and progress in the performing status of the loan book. We're still on track to resolve the single obligor limit position by year end. Importantly, I want to emphasize that the obligors remain operationally active and continue to generate robust revenues. We're pleased to confirm that the first phase of the private placement capital raise has commenced. We will obtain the regulatory approvals required to conclude the transaction and close out this first phase in November 2025. This means that First Bank will comply with the minimum capital requirement by year end. In the upcoming year, we intend to make progress on the balance of our 350 billion naira capital raise program. The funds obtained will be strategically allocated to advance our objectives and capture new value and creative opportunity. Before we move to Q&A, I would like to express my satisfaction with the strong performance of the group during the period. I would like to thank the team as well as our operating companies and their respective leaderships for their valuable contributions. We remain committed to our strategic goals and are confident in our ability to deliver optimal value to our stakeholders. On this note, thank you for taking the time to listen. I will now hand over to Tolu to moderate the Q&A. Thank you.
Thank you very much, Wale. Just as a reminder, we'll take questions in the Q&A session. We'll take questions now. Use the raise hand function to indicate that you need to ask questions. So moving on, we can take a question from Ahmad Buhari. Please go ahead.
Good afternoon. Thank you very much for taking my question. So I have a few questions, please. The first one is, what should we expect in dividends for full year 2025 and full year 2026? Secondly is regarding the prudential regulations for holding companies to have the minimum paid up capital for the HoldCo to be greater than the sum of the minimum paid up capital of its subsidiaries. Is First HoldCo currently in line with this regulation? And if not, what is the shortfall? Next is regarding the NPL. What are management's plans for the reduction in the NPL ratio? And then the merchant banking business sale, has it been concluded? And if not, what is the status, please? And then finally, your thoughts, please, on the pension recapitalization and the implications on the PFC business. What is the shortfall, please, and what is the plan? What are the plans around recapitalizing? Thank you very much.
Thank you very much. Regarding dividend expectations for 2025 and 2026, as we had reiterated at the market earlier on, the HoldCo will continue to pay dividends. We will pay dividends for 2025 as a HoldCo. Remember that we have companies within our group, which are non-bank subsidiaries, will typically upstream dividends to us. So we will be paying a decent level of dividends. 2026, there will be a significant increase in the level of dividends that we'll be paying, and that's on the back of the fact that all our operating entities will upstream dividends to the HoldCo, which we will be paying to our shareholders. On the minimum capital and minimum paid up capital regulation regarding holding companies, we will work towards that. I do believe that at the moment we are compliant, even with the additional capital raise. If there's any difference, we will work with the regulators to ensure that we close that out. I will take the question on the merchant banking sale. I will say that that is probably close, subject to very some little regulatory approval. So we've come to the end of the road on that transaction. more or less. You'll permit me to have the bank CEO speak to the NPL issue and the pension capital implication for the PFC, which is a direct subsidiary of the bank. Thank you. CEO, please.
Thank you. There was a question on if HoldCo has capital more than the sum of capital of subsidiaries. The answer is yes. Again, HoldCo is the shareholder in the bank and the subsidiaries. So it's the capital that they have that they deploy to the subsidiaries. So there's no way it should be the other way around. So if you check, the sum is always there. So you consolidate yourself up at the end of the day. So consolidation take care of that. And you know the way it works. If an operating HoldCo, the CBN will deduct the capital of subsidiaries from the entire group capital before they arrive at yours. So it solves that problem. So we are compliant. And on the issue of NPL, 2-3 names account for about 70% of our NPL, as you will see that we've displayed over time. And we're working towards resolution of those 3 names, and they're all known out there. We believe that within the next 6 months, there will be a lot of progress. Even before the end of the year, there'll be a lot of progress. It might not be possible to reclassify them back to performing before the end of the year, which is 2 months away. For prudentially, you must have at least 2 quarters of consistent performance before you can reclassify back performing. So it might not be possible to achieve that by year end, but surely before half year next year, we'll have those accounts performing or we'll take decisive action on them. And it's to write off of the packet. The last question here is on the pension custodian business. We are fully compliant. The rule says 25 billion and then 0.2% of assets under. So based on where we are today, they have 25 billion. I think our shareholders fund is not of 6 billion. And so 25 billion is just dead. 0.2%, looking at what we have for even half a year, we are far ahead of that. So the only implication you're going to see across the industry, maybe it will hold back the size of dividend that you can upstream. Not that we are going to reach accounting. So for us, we'll be far, and there's no year, looking at what we are doing and our profit target, there's no year we're going to push it. Today we are solid, we are sound. There's no need for us to drop additional penny to that business. Thank you.
Thank you, CEO.
Thank you, CEO. Okay, so we'll take next question, and that's from Stephen Chima. So the question reads, could you comment on the facilities or sectors that have seen the most recoveries on the bank's number?
Thank you, Stevie. We'll have the bank CEO take that.
Okay. If I'm right, or if I understand the question, recovery means where you recover from your NPL issues more. It is in manufacturing. Manufacturing sector, even when they have issues, because they are businesses with presence and they deal with the economy, you can always see the activities. And when there's a flip in the economy, you see that positive momentum also filtering into their own activities, and you see that moving. So we've seen that progress. And if you note the NPL on manufacturing is actually very low. The real problem has always been oil and gas. And the oil and gas issues started in 2013 when the entire industry went into this, I would say, indigenization in the oil and gas industry, where Nigerians got assets, they were funded, and we ran into crisis along the side. So if you just check all the names in the industry, these are the things you're going to see. Other than that, I think the entire industry, telecom, manufacturing, trade, services, they're actually stable. Thank you.
Thank you, Steve.
Thank you, Suyo. Okay, so we'll go to the next question. And that's from Ngozi. So Ngozi asks, what is the progress of the private placement capital raise and how much will be raised?
Thank you, Ngozi. We have a 350 billion program that we seek to execute. Like I mentioned earlier in my opening remarks, we will conclude the entire 350 billion in 2026. As it is today, our focus is on raising monies via the private placement in the first tranche to take the bank to the 500 billion naira stipulated by the central bank. So put it this way, we will have all the funds required from the private placement and any other resources of the HoldCo to get the bank to the 500 billion naira bank. If I'm not mistaken, that totals about 122 billion naira, which is what will get the bank to be compliant. And that will be achieved on or before the end of November 2025. Thank you.
Thank you very much, mate. Okay. And as a reminder, please use the raise hand function to ask your question. So we could take the next set of questions. Okay, we have a follow-up question from Stephen Chima. And Stephen wants to know what the year-end cost of risk is likely to be.
Thank you, Stephen. The full year cost of risk will not be less than 5%. And the GMD was being diplomatic in its answer to private placement. The reality here is that the money, 1 to 2 billion, is already in the pocket. We are only waiting for regulatory clearance. So the fund is already in use.
Thank you, CEO. Okay. So we have to take a new set of questions. Please use the raise hand function to indicate to ask questions. Alternatively, you can have your questions typed in the Q&A section. Okay. So we have a question here, and it wants to know, would you give us a sense of what the FCY and LCY splits is like on the loan book, and in the same vein, deposits and other liabilities as well?
Okay, for the loan book, foreign currency, Nigeria here, taking that all other exposures outside Nigeria with foreign currency. As the line is about 48 to 52, 48% foreign currency and 52% local currency. And by the end of the year, we are likely to see a reduction in that position. For liabilities, Nigeria, you have about 2/3 of our deposits in Nigeria are local currency. and about 1/3 foreign currency. Thank you.
Thank you, CEO. Okay. So moving on to the next question. Gloria Felipe wants to know, what drove the considerable moderation in interest expense in the 9-month period?
Let's take the second one. So you should
Okay, so let's say that's so. And that question, what's the status of your loan forbearance? So I can take that first.
Okay, for 9 months, we set out to reduce our interest expense cost. One, we decided to close out on expensive deposits. So it was a deliberate plan by the bank to pay down on expensive deposits. So it's not about growth for the sake of growth, but we wanted low cost funded base to allow us to navigate through and watch next year. You are likely to see the same pattern. So it's deliberate, and we are working towards that to ensure that we bring down our cost of funds. On forbearance on cost, by the end of the year, we will have fully exited forbearance. And the issue outstanding here today is the SOL. And SOL issues will be closed by year end. As stated by the GMT, those accounts remain very active. One of the big accounts that you can see, but by year end, the SOL breaches will be closed. Thank you.
Thank you, CEO. Okay, just on the same question, I think on the same pattern. So there's a question here about could you please comment on the resolution of the GHL legal disputes?
Oh,
That's another for them. There's also another question on Tio, so just take it together.
okay. Were you about the banks that get a loan? So, if so, how do you treat or classify a loan by the end of forbearance in June? ITO loan, yes, we're one of the banks that syndicated for ITO. ITO upstream was undergoing restructuring. So as of June, we also had to classify it, the account. And once restructuring is completed, of course, it will be NPL. For the general hydrocarbon legal issue, I'm sure you are aware that the bank won the arbitration. In fact, GHL case was dismissed, and First Bank was described as beyond reproach to my client. Two, the issue before the Court of Appeal, First Bank won. It was also very clear. Including the mandate to sell the crude. The registrar of Court of Appeal will act on the decision of the Court of Appeal. And so cash flow is imminent. I hope that clarifies. With that, in those two judgments, I think the path is now clear for full resolution of the GHL issue. And it's one of the NPLs that we spoke about earlier. That is off our books. You see the NPL ratio crashing very fast. Thank you.
Okay. Thank you. Thank you, CEO. Okay. Okay, as a reminder, please use the raise that function and then we can move to the next set of questions. At this point, there is a set of questions. So you can either have the send your yes. So so we take this question from Juliet. You quote Mulder. Congratulations on your 9 months results. What drove the decline in the group's non-interest income and the increase in impairment charges? Say that before.
Okay. The non-interest income last year was high because of currency gains, currency development. And so back to markets, and valuation gain, fair value, and valuation across the industry drove non-interest income. But in 2025, that normalized. So the non-interest income portion for the revenue went down. I'm sure you saw that across the banks that published their RBA and MIB explanations. The increase in impairment charges is as a result of the end of forbearance. So the banks now need to quickly cover those exposures. So I'm sure you also saw that across the industry. Banks trying to quickly cover that, and that's so that they can exit. That's what we try to ask. And that's what we're confident by the end of the year, even on the NPL forbearance issues, we'll have cleared ourselves.
Thank you, CEO. So just on the same topic as well, we have this question from Olumide Shule. We are seeing most banks writing off their forbearance exposure in their H1 25 results. How much has First HoldCo written off as we speak?
Details of that, I don't have the complete figure, but what I can assure you is that by the end of the year, we're legally compliant. Thank you.
Thank you, CEO. Okay. Do we have any a set of questions, either in the Q&A section, or you can also indicate by raising your hand. Using the raise hand function. We'll take a pause just for you to ask any of your questions, and then we'll take that. Okay. There's a further question. Well, the GMD had already spoken on this in terms of the outlook for on dividends. Do you want to give us it?
No, I answered that already. We're a holding company. Dividends will be upstreamed from various businesses. There'll be dividend payments in 2025 and a stronger, more robust dividend payout in 2026, when all our operating companies will be upstreaming dividends. There's a question we missed out on loan growth guidance for 2026. CEO, do you want to speak to that?
Yes, thank you. For 2026, depending on the variables and how the macro play out, it's practically an election year. So when we expect inflation to drop, we also expect currency to stabilize, barring any geopolitics. that may affect the ecosystem. If that is correct, our loan growth for next year will not be less than 10%. Thank you.
Thanks.
Thanks you. Okay. Do we have any further questions at this time?
So raise their hands.
Okay, if you have any questions, again, just as a reminder, please use the raise hand function on the platform, or you can have your questions typed in. And we have another question here from Gloria. Gloria wants to know, can you also share the 2026 outlook for the cost of risk?
For 2026, the cost of risk will be less than 5%. Hope that helps.
Okay. Gloria, I hope that answers your question. Okay. Right. Okay. So there's a question on interim dividends for Olumide. For dividends, when should we be expecting a return to interim dividends?
Thank you, Olumide, for that question. The jury is out about the significance or the value that comes with that. We will decide at the appropriate time, but honestly, we're committed to pay a handsome dividends to our shareholders. And like I said, dividends for 2026 financial year will be quite strong and robust. At that time, we'll decide whether we want to do interim, pay interim dividends. Well, obviously we didn't pay this year, but next year we can look at it. But honestly, the jury is out about the value. What you find out when you go to the AGMs is that when you pay the interim dividends, people have forgotten about it and they focus on what you pay at the full year. But what you can take to the bank is that we will return to paying very handsome dividends to our shareholders in 2026. Thank you.
Thank you, Wally. And and further question here from Gloria. Less than 5% seems a wide range. I'm assuming cost of risk should be significantly lower given a large need to risk balance sheets. So, CEO, what's the
Gloria, because I can't sit here and say it should be 1% or 2%. It's safe for me to be that it should be lower than 5%. When we started this year, we never planned. They were going to find ourselves here trying to clear forbearance and make massive provisions. So if people are giving you guidance in January, I'm sure all those ratios that you use right now. It's safe for me to say to below 5%. But I think it's just like that. By the time we get to Q1 next year or Q2 next year, to be clearer where we're going. We've seen many developments in the economy in the last 90 days that I'm not sure we all expected. But they all point to positive direction. If you just look at what has happened to the price of fly, what has happened to FX rates, what happened to interest rate, exchange rate, the inflation rate, and all that, it points to something positive. Things might be better next year than we expected. So even the ratio might come down faster than we expected. So many things that can influence cost of resource. I wouldn't want to sit here and tell you 1% is with that, price below 5. When we get there, the real numbers will show something. Thank you.
Thank you very much. See you. Okay. Perhaps to take more questions. If you have any further questions, please indicate either in the chat, in the Q&A section, or by raising your hand.
Yeah.
Thank you for that question, Olumide. We had guided the last investor call that the capital will be raising, will be injected into further strengthening the flagship subsidiary, that's First Bank. We are also exploring new business adjacencies, and I can assure you that that capital will be deployed into those new areas of business that we're working on. And really, to be quite frank, I would say we're at some advanced stages in terms of those discussions. So how we will allocate the capital has been well laid out and agreed upon, and we will be coming to the market at the appropriate time to advise you of transactions that we have sealed and dealt. I hope that addresses your question.
Thank you, Ali. All right, there's a question here from Oluwadamilola again. And Oluwadamilola wants to know that with the loan increase in loan book of 9%, please, in which sectors did most of the growth occur?
The 9% growth occur virtually across all the lines. So we have oil and gas, that's true. And you can see that with the increase in production, in the cost of petroleum products in the last 12 months, you've seen increased value with respect of that. We also have transition impact coming in from manufacturing side and from oil and gas upstream side, not because of really low growth, but because of currency translation also affecting oil and gas upstream. We have some in telecoms, where you see MTN, other players, and we have some in coming to general commerce. Generally speaking, all spread across the sectors.
Okay. All right. Thank you again, CEO. So we have this question that how does the CR cut impact the bank in terms of loan growth and liquidity?
The CRR is according to so it's not specific, it's not targeted at First Bank. Yes, we have over 4 trillion in CRR as a bank. But we must understand the fact that even if the entire fund was released to First Bank, the economy might not be able to absorb more at the same time. And the country had to deal with inflation and deal with things. So the country must survive before the US will survive. In loan growth, I would say they affected our loan growth because even the demand for loan was low because of the high interest rate environment. Consumer purchasing power also reduced. Inflation itself inflation is what I say now, feeds on the disposable income of individuals. So on its own, it's a tax on disposable income. So when you see high inflation, reduces purchasing power for them. That affected manufacturers. So people coming for loans, not much. So on liquidity, you have 30% liquidity ratio. We all met our ratio 20%. So what you know to do is to have excess liquidity that will be stored in the microeconomy. But we're all able to manage through and get things through. So no material impact. I mean, just the economy. Thank you.
Thank you. Okay, so Olude, I hope that clarifies on the question, please. Okay. Do we have any other question? Any further questions either in the Q&A, or you could raise your hand and speak to and ask the questions. Okay. There are no further questions at this time. So in the absence of any further question, I'll then invite Wale to provide his closing remark.
Okay, thank you, everyone. Thank you for signing in. Thank you for participating in this investor call. Our message to you is that our core business fundamentals are very strong. We've grown significantly and will continue to sustain that momentum while repairing and strengthening our balance sheets. As we've already indicated here, we would have dealt with our forbearance loans at the end of the year, and 2026 looks to be a very promising year for the franchise. I'd really like to appreciate you for following us through the year and seeing us transform as we move on. Be assured of our commitment to ensuring that we enhance shareholder value. Be assured also that as we receive capital from the market, that they will be deployed in a way and manner that will further enhance value. Just to say a very big thank you to you and wish you a pleasant evening. Thank you very much for your time.
Thank you very much. And then this concludes the first HoldCo 9 months 2025 results earnings call. Thank you for participating. Thank you for joining, and do have a good day ahead. You may now disconnect.